John Perrings with Stacked Life here, and I'm here to talk a little bit about a timeline of the infinite banking concept and whole life insurance, and so you can get an idea of what would this look like. What are the principles that can be applied over the course of your financial life? So let's kind of dive into here. The first part is we'll have an income, right? So this income, our greatest asset is our ability to earn an income. This income comes into our life, and normally this will hit like a bank or a 401k, some type of, qualified plan. A lot of times that money will be gone before it even hits your bank. So what we're going to do is we're just going to replace this with a whole life insurance policy. Whole life insurance is an excellent place to store cash in a strategic manner. You could think of it as capital accumulation. Capital is the money value of something that is used to create something else, to go invest in something else. So what we're doing is we're strategically accumulating capital with whole life insurance. Comes along with a ton of benefits, like it earns a very respectable tax-deferred rate of growth. You can get to it tax-free through the use of a policy loan provision. It has chronic and terminal illness protection. And then, of course, the true purpose of life insurance is the death benefit, and that's where the cash value comes from. There's that guaranteed death benefit at the end of your life that'll be income tax-free to your heirs. So tons of benefits. You could think of this, it's very similar to when you buy a house. When you buy a house, you have your income, it comes in, you make a mortgage payment. That mortgage payment builds equity. Every time you make a mortgage payment, it builds equity in your house. And then the value of that equity, you can get a certain amount of that equity in the form of a home equity line of credit. It's actually really very similar with whole life insurance. And so it's just a different asset that's backing the HELOC. So, and in our scenario, what we're doing is we have income coming in. It comes into a whole life insurance policy that builds equity in the death benefit. And that's just called cash value. That's the equity. And based off of the value of this, we can get a line of credit called a policy loan. The difference between a policy loan and a HELOC is the underlying collateral is guaranteed by the lender itself, which is the insurance company. The underlying collateral of a HELOC is your house, which is not guaranteed. The policy loan provision is a guaranteed provision. Once you have a policy loan out, it can never be called on you. If we go back to 2020, Wells Fargo stopped issuing lines of credit, home equity lines of credit for a period of time. So there are lots of situations where this can be a suboptimal decision. The other one is you have to apply for it. Even though you have your home equity here, you still have to go to a bank, show them all your financials, apply for the line of credit. With this one, with the policy loan, you literally just call the insurance company, say, hey, I want a policy loan, and they'll give you up to 98% of the cash value. And so everything's already collateralized by the cash value. So they have no problems. You don't have to apply. You don't have to issue any financials. It's literally as easy as picking up the phone or requesting the policy loan. So the benefit here is just like your house, when you're using this HELOC, as long as, of course, the property value of your house continues to go up, that asset value, it doesn't affect the growth of that asset value. It's the same thing with life insurance. When the policy loan is out, it does not affect the growth of your cash value in the life insurance policy. And of course, the difference here is a life insurance policy, especially whole life, can never go down. It only goes up. There's a guaranteed growth component, and then there's an annual dividend component that's not guaranteed, but no matter what, the value of this policy is only going to go up. So there are a lot of benefits to using it this way. And this is kind of the basic mechanics behind the infinite banking concept, where we capitalize a whole life insurance policy that every time we make a premium payment, it builds equity in the policy. That's the equity in that future death benefit, which is a guaranteed future cash flow. And then we use the policy loan provision to get some leverage on that cash value in a safe manner, where everything is guaranteed by the insurance company. There can never be any problems with a policy loan, as long as you keep the policy in force, of course. So I'm going to go ahead and remove these for right now, and let's go back to our timeline. Okay, so here we've capitalized the whole life insurance policy. So now we have cash value. We have cash value sitting here. There are only two things we can do with our money. We can either buy liabilities or we can buy assets. We can spend or we can save. And here's a truth that not many people understand. And the crux of the infinite banking concept is that you finance everything you buy. This is Nelson Nash. This is a core economic principle. Can't get away from it. Doesn't matter who said it, but Nelson Nash talks about this in his book, Becoming Your Own Banker, which is the source material for the infinite banking concept. And you finance everything you buy. You either pay interest to someone else when you use their money in the form of loans or lines of credit, or you give up interest you could have earned when you pay cash. And so if we look at a typical use of money, America is just laden with debt right now. So a lot of times what happens is people take loans and then they pay them back. They take another loan, pay it back over time, take another loan. Excuse me, my whiteboard's trying to do some unhelpful autocorrect, and you pay it back over time, right? The other option is you save up money and then you spend it, save up money, spend it, save up money and spend it. So either way, no matter which way we're doing this, we're always ending up back at zero, basically. So what we want to try to do is, the infinite banking concept is about changing this whole dynamic. I'll just leave that up there actually so we can compare. We want to change this dynamic. So obviously this is time and this is money. What we want to have happen with any account is we want that account to grow over time. So here's a compound curve of our money growing. This is the cash value in a policy. We want uninterrupted compound growth on that cash value, and that's what you get. And then when we use the policy loan provision, because we're not taking money out of the account, we're borrowing against it, this graph, instead of always going back to zero, starts to look like this, where you take a policy loan and you pay that back over time, take a policy loan, pay that back, another policy loan, and pay that back. And so what ends up happening is I was able to save and never eliminate the growth on the cash that I've accumulated in the whole life insurance policy, even though I had the money out there doing other things. So maybe this was buying a car or buying a rental property, whatever it might be. Maybe it was paying for college. Whatever the case is, when I'm done paying these policy loans back, look at where I am. I never lost the trajectory of where I was supposed to go. Right. The one caveat to this is, when you use a policy loan, there is an interest payment on that loan, even though it's collateralized. So in reality, like if we were to zoom in here, there's still a little bit of lost growth on that amount of interest that we're servicing with the policy loan. But what we're doing is we're minimizing the effects, as opposed to completely losing that growth altogether, which is what we get in the model on the left over here. So going back to the timeline, let's take a look at that again. All right, so here we have our cash value. Again, we can buy one of two things. We can buy liabilities or an asset. The idea behind IBC is that we are strategically saving money in a whole life insurance policy so that we can finance the things that we need over the course of our life. Nelson Nash talked about how our need for financing will probably outweigh our need for death benefit. We need that death benefit there, but the main thing we're going to need is a source of financing through our life. So what could we do with this cash value? Well, what if we needed to buy a car, for example? We could take a policy loan. And let's say we borrow this money from the insurance company at 6%. We buy a car, and the going rate of interest at a bank is 8%. If we weren't doing this, we would be more than willing to either pay cash and give up 8%, or we'd be willing to go to a bank and pay them 8%. So if we are the bank and we've become our own banker with our whole life insurance, why wouldn't we be willing to pay our own bank back at the going market rate? So the idea is we would pay this back at 8% interest, which is the going market rate. And what happens here is I'm capturing a spread of 2% that's going back to my quote unquote bank on a transaction that I was going to do anyway. And so now, instead of the bank getting that 2% spread, or the auto finance company getting that 2% spread, you're now including this 2% spread to grow your financial life and improve the things that you want to do. Now, of course, it matters what the interest rates are, so that's just something we have to talk about. But in this scenario, this is kind of a actual pretty, I'd say, fairly accurate scenario where if you went to buy a car, you might have an 8% interest rate on a car loan, and you can get roughly around a 6% interest rate on a policy loan right now. So you could capture a spread, and then what that's doing, it's creating a tailwind behind all of the financing that you're going to be doing over the course of your life. You're adding a little tailwind behind you to help push you through your financial life, and that adds up to massive improvements over a long period of time. So that's buying a liability. What if we wanted to buy an asset? So in this scenario, what if we wanted to buy a rental property? So over here, we again use a policy loan at 6% interest. We go buy a rental property over here, and that rental property is throwing off a 10% rate of return, right? So most people would take a look at this and they would say, well, 10 minus 6, and I'm getting that 4% spread. But it's actually way better than that, because if you look at it from a dollars perspective, if you can spend $6 to earn $10, that's about a 67% rate of return on that money. And this is the benefit of being the bank, because now you're using other people's money, the insurance company in this case. It's just leverage, and now you're able to take advantage of it. And so these are the types of things that you can do as you go through your working life using IBC. And so this is going to, what we've done here is we've created a certainty asset in the form of whole life insurance cash value. We've created a certainty over here in the form of a life insurance death benefit at the end of your life. And then we're creating a growth factor by capturing a spread on all the things we're going to buy over the course of our life and all the investments that we may want to do. Now, so this is kind of like what's happening during our working year, so to speak. So the next timeline is what happens when we get to retirement. Well, because we have this guaranteed cash value, the biggest danger in retirement is called sequence of returns risk. Whereas if you have in your retirement accounts $1 million, just to use round numbers, the academic research out there says that you can use what's called the 4% rule, or a Monte Carlo simulation, if you've heard of these, and that says you can safely withdraw 4% hopefully without running out of money. However, these simulations are a little bit flawed in that we still don't know what's going to happen in the market in the future. But these are sort of this is the academic research. Well, the reason for that is in your retirement years, as you're withdrawing money from your retirement accounts, if the market goes down, and the market goes down on average 3 times out of every 10 years, if the earlier those happen in your retirement, so if you're just unlucky to have down years in the market during your retirement and you have to pull money out of there while the share value's down, it can cannibalize the shares you need for the account to bounce back, and you can end up running out of money. The earlier these down years happen, the greater the risk is. And so this is a really big problem that not a lot of people are prepared for. So what we do is, like, let's just say we got, our IRAs or qualified plans, whatever, these are your retirement accounts. And then over here, since you've also been building up cash value during your working years, this is guaranteed to only go up. And this is more risk-based, but we get some growth out of this. So let's say in the first year, you take out $40,000. And then the next year is a down market. So we don't take any money out of here. The first year is an up market. The second year is a down market. We just switch over here, and you can get tax-free income from your cash value to live on during this down year. And what that does is it allows your account value to go back up and recover from that negative year. And when that happens, now you can just switch over to your retirement account to get that income. What we find is when we have this available, you can almost double the amount of income you can get in retirement. The withdrawal rate increases significantly because we no longer have to worry about the down years in your retirement accounts. We no longer have to worry about that sequence of returns risk because we can always go over to the guaranteed side anytime there's a down market. And the research shows if you have even 2 of these years, if you can just switch over to this for 2 down years, you can almost double, if not more, your retirement income in a safe manner. There's also strategies using this, a similar concept here, using annuities that actually do the same thing but give you even more guarantees, where you can create guarantees for the rest of your life. But a lot of people like the volatility buffer. This is called the volatility buffer option because they can just keep their money invested and they're not sacrificing upside if they get it, but they're protecting themselves against any downside during their retirement years. So that gives them a lot of money to use and enjoy during their retirement. And then the last phase is what happens when you die, and we want to plan how are we going to pass this money along to the next generation. Well, because you had this guaranteed death benefit, tax-free, this is income tax-free. There could be estate taxes involved, just depending on your situation, but in general, this is an income tax-free death benefit to your heirs. If you think about it this way, what happens in retirement a lot of times is whatever you end up with over here, let's just say that it's that $1 million. Obviously, we probably want more than that, but whatever happens over here, that retirement account for a lot of people ends up trying to do too many jobs. It's got to provide your retirement income. It's got to provide liquidity that if there's any kind of an emergency or health situation, and then it also has to provide a legacy for your children or your heirs. And so this has a lot of pressure on it to do a lot of different jobs. So the first thing is the whole life insurance comes with chronic and terminal illness riders that can help protect against major health issues, protecting this retirement fund. And then the death benefit gets paid out to your heirs so they get that legacy tax-free, which allows more of this, which protects that retirement account even further. And so what we find is having the presence of this guaranteed permanent life insurance death benefit kind of gives you a permission slip to use and enjoy all your other assets while you're still alive. And then this death benefit creates the scenario where your heirs can benefit from that tax-free death benefit. So you get to spend your money that you made over here, and then your heirs also still get something at the end. And so if you're a high net worth individual, there's no matter what they say, it doesn't matter how you set things up, there's no better way to cover estate taxes than having a big life insurance death benefit. And what's going to happen is when you're in your 60s or 70s, your estate planning attorney is going to say, hey, we should look at some life insurance to cover these estate taxes when you die. And by that point, the best case scenario is you'll be 30 or 40 years older, and the premiums on the price of the premium is going to be way higher when you're that age. So it's going to be way more expensive to buy the insurance. Or worst case scenario is something will have happened to your health by that time, and you will no longer even qualify. So there's going to be a huge tax bill due at the end of everything. There's no better way to estate plan than having at least some permanent life insurance. And the thing is, you can have all this, and you can double your retirement income, and you didn't have to spend any extra money on the way to get there. All you have to do is have a portion of what you're building over here be permanent guaranteed life insurance, and it provides these benefits. 67, this is just an example, but massive increases in your rate of return because you're getting safe leverage. You get a tailwind behind you and financing all the large purchases in your life. You can double your retirement income, and then you can pass along more to your heirs. And you didn't have to spend any more money to get there. So hopefully this was helpful. A lot of times people are just kind of wondering, how does IBC and whole life insurance, what does this look like big picture? And a lot of times people get caught up in the numbers, but what I advise is to try to focus more on the principles of having that certainty asset as at least a portion of your life. And when you do have that in place, it gives you so many options. By the time you need to make a decision, you have options when you get there, where most people, they only do one thing. They only focus on accumulation in investment type of assets, not distribution assets like life insurance. And when they get to a point where they have to make a decision, their options are much, much more limited because they only have one type of asset, and they only have a couple moves they can make. So click the link below or hit my link in bio wherever you're watching this, and you can ask any questions in the comments that you'd like, or feel free to reach out to me and schedule a 30-minute free consultation, and we can talk about how this could apply in your life.